In this week's video, we're going to expand on what I spoke to you about in the last video, and that was the testing process of a strategy. Now, for those of you that were not able to watch it, there's a link in the top right of the screen here. This is where I talk about how you can showcase the probable future returns using a very powerful spreadsheet, which you can in fact download in the link below. Since the last video, I've had many of you asking about these metrics and where they come from, and what are the important results that we should be looking at when we are analysing and testing a strategy. So I'll be answering those questions for you today. Sit back, take notes and enjoy. Now, as we've all heard before, when trading the financial markets, it's imperative for the long-term consistent success that you actually have a strategy in the first place, which, as you know, are the rules of engagement. You know, when you're going to buy, when you're going to sell, the percentage risk that you're going to trade on each trade, money management, and so on. Now, you'll be amazed, quite frankly, by the number of people that I've spoken to over the years who are still trying to find their way in the markets, and they don't actually have a trading strategy in the first place. You know, they're trying to outwit the markets with the gut feel. You know, they're actually risking their hard-earned money, as bizarre as it may sound, with no trading strategy. It will always happen, has done for years, it will continue to happen. Perhaps maybe I should be thankful, because it's those losing traders with no strategy that help pay for us winning traders, the ones with this strategy that's been tested and proven. So with that mini lecture over, let's assume now at this juncture that you've actually got yourself a strategy. Now, if your strategy is totally mechanical, or an expert advisor that you've purchased or developed yourself, then of course to test this strategy you can simply run it through Strategy Tester on MT4, or indeed you might want to use some software like Fورk's Tester 3 to actually test the strategy to see how it performs in past data. Now, if you're trading using a discretionary strategy, that's like using support and resistance or trend lines or Fibonacci, then you'll need to simply, as laborious as this may sound, need to scroll back in terms of historical data through the price chart, looking to see how that strategy performed on historical data. Now, as painstaking as this may sound, when you're manually backtesting the strategy, logging each trade candle by candle, keeping a physical record, you know, that's sometimes the best way to evaluate and test a strategy. You get to know its characteristics as you go. Now, once you've run your strategy through some historical data, you're going to get to see whether the strategy made money or not. Was it profitable? Was it a losing strategy? But to truly know your strategy, you need to look deeper into it. And there are a number of metrics that we use to evaluate the strategy, and that's what we're going to be talking about now. Now, having this data to hand really is so important when you take the strategy into the live environment. You get to know whether the strategy is conforming to what's expected. You're going to get to see that the strategy may in fact be broken at some point. And it's only by having these metrics, something to gauge it against, will you have that information. Now, these metrics are quite easy to understand, quite simple to calculate, and I'll show you them now on the whiteboard. Come on. Now, when we are evaluating a strategy in our backtest using metrics, we should be looking at the relationship between the metrics with each other, not just a standalone metric on its own. And the first metric that I want to talk about is the commonly used win rate. Now, the win rate is the number of wins over the number of trades in that testing period. And of course, the loss rate would be the opposite, the number of losses over the number of trades in that testing period. And be careful of the win rate, because it's what the vendors use to try to sell their courses, to try to sell their strategies and so forth. They'll talk about a strategy with a 80 or 90% win rate. That basically means they're making 90 winning trades for every 100 trades taken. They're only having 10 losing trades every 100 trades. But be careful when you see strategies advertised with a win rate of 90 or something like that, something high like that, those high percentages, because that often sounds too good to be true. And I think we all know how that expression completes. If it's too good to be true, I'll let you finish off that sentence. So the next metric we want to look at is the average win and the average loss. So the average win is simply the total dollar profit on the winning trades divided by the number of winning trades. Okay, that gives you the average win. And the average loss will be the total dollars lost on the losing trades divided by the number of losing trades. That gives you the average loss. And it's the relationship between these two which is much more important than them on a standalone basis. So for example, you could have a strategy with a win rate of 95%. That means it's going to win 95 times out of 100. But each time it wins, the average win could be just $10. That will give you a profit after 100 trades of $950. Okay, but the average loss, well, you're going to have 5 losses every 100, and if the average loss is, say, $200, then you're going to be losing $1,000 on those 5 losing trades. So you can see the relationship between the average wins and the number of wins and the average losses and the number of losses is very, very important when evaluating a strategy. So don't be sucked in just because you see a strategy with a 95% win rate, because if you're losing the house on the other 5 trades, then obviously that is not a good strategy. Now these next two I've lumped together. You've got the profit factor and the take profit ratio, or known as the TP ratio, pretty much showing the same thing. Now the profit factor is simply the total dollar profit divided by the total dollars lost. Now anything over 1 clearly is a profitable strategy. When I'm backtesting, I like to see anything over 1.5 really on a profit factor because of the vulnerability sometimes of the backtesting data. And the TP ratio, you'll see this referred to in the Excel spreadsheet that I showed you in the previous video. We look for a TP ratio, which is basically the average win over the average loss. It's very easy to calculate these metrics from your own backtesting. If you've done them manually, very easy calculations, so you can get your TP ratio and your profit factor of that particular strategy that you might consider taking forward in the live market. You must know what the profit factor is, what your TP ratio is of your strategy. Now, once you have these metrics worked out, you can come to the next metric, a very important metric, very useful metric in determining the strength of your strategy, and that's the expectancy. And the expectancy is simply the win rate multiplied by the average win divided by the loss rate, which is multiplied by the average loss. So you've got all these metrics worked out, you put them into simple calculation, and you come up with an expectancy. And the expectancy is basically showing you how much you can expect to win on every trade that you make. Clearly you need a positive expectancy to have a profitable strategy potentially. So if you have an expectancy of say $15, then you can expect to make $15 on every trade that you make, including the losses. So if you make 100 trades, then you'd expect to make $1,500, 100 times 15. Okay, that's the expectancy, a very important metric which we use in evaluating a strategy. Moving on, drawdown. Most traders don't look at drawdown. Big mistake. Drawdown is very, very important. Imagine you start off with $1,000. Great strategy, takes you up to $1,200. Then you have the inevitable losing streak, comes back down, and now you only have $700. Then you hit some winning trades, you're back up to $1,100. Now on paper, you've made 10% on that trade after the trading period. You've had a 10% gain on equity. But within that, you've actually had a drop of $500. Okay, $500 from 1,200, so 500 divided by 1,200 will give you about 41% drawdown. So would you still be trading that strategy? Would you be trading a strategy to make 10% with a potential drawdown of 40%, something like that? Well, you've got to know that before you actually take that strategy going forward. Drawdown is one of the most underrated metrics that traders do not use when they're looking at strategy. So potential drawdown is crucial when evaluating whether to take that strategy forward. So when you're considering all these different metrics which are crucial to evaluating a strategy, you should also be aware of the next metric. And this is the consecutive wins over the consecutive losses. We're all familiar with the random distribution. Remember, we spoke about it last week in the coin toss. Here you've got 100 tosses. Okay, we know the outcome, it was 50-50 at the end, so you had a win rate of 50%, but within there you had 8 tails on the bounce. You had 11 heads on the bounce. You do not know when the wins are going to come, and you do not know when the losses are coming by just looking at the win rate or the loss rate. You know that's what's happened over your back test, but you don't know the succession or the distribution or the random distribution of when they will happen. So you need to be aware of the maximum consecutive losses that you've had, consecutive wins that you've had in the strategy. So when you actually start trading this in the real environment, then you can see whether it is conforming to your backtest. And that's why the Excel spreadsheet that we gave away last week, and you still download it today, is so important to run your strategy with those metrics through into the forward-looking unseen data. Okay, so I appreciate there's quite a lot going on here. A lot of metrics, a lot of definitions, a lot of calculations. It's all quite simple if you actually digest it slowly. But it's worth looking back at some of your past trading records and see if you can work out what your expectancy is, what your average win-loss ratio was, your take-profit ratio, what the expectancy is, and see if that strategy really is performing the way it should be performing, and is it worth taking it forward. Now, I know there's a lot to take in. In the next video, because this is a 3-part series, we're going to be taking these metrics and looking at some backtesting software, or looking at MetaTrader 4 and seeing how they relate to the actual chart, and see how you can see the equity curve and how the different metrics affect that equity curve. As always, if you like my video, give me a thumbs up. If you didn't, give me a thumbs down. Don't forget to subscribe to the channel, because if you do, you'll get notification the moment I send out the next video, taking all this and putting it on the price charts, on the backtesting software as well, when everything will become a lot clearer. So until next video, speak to you soon and happy trading.